Hey everybody, this is David Skarica. It's Wednesday, November 19th, and we are going to do an interesting video here today. I got this idea actually. I was looking at Mark Holowesko's ex Twitter page. For those of you who know, Mark Holowesko is he's a Bohemian who basically worked for John Templeton and then kind of took over for John Templeton, his fund in the 90s, and now runs hedge funds out of Nassau, Bahamas. And he was talking about the yen carry trade. Now, this is something I've talked about for decades. And it was weird being a guy in my early 20s, an investor in my early 20s, or a writer in my early 20s, talking about the yen carry trade. Wasn't something, usually younger investors are talking about high growth tech stocks or something like that, right? But I guess I've always been a worrywart. So what this essentially trade is where you have risk on trade where hedge funds, investors, etc., they'll borrow in yen and borrow at the Japanese interest rates, which have been the lowest in the world. They've had zero interest rates essentially on the short end for, you know, almost 30 years, 20 plus, 25 plus years. And then, they've had rates on the 10-year bond south at 2%, really since the late 90s, and, south of 1%, for about a 10-year period or more than 10 year, roughly a 10-year period from about 2012 to 2022. And of course, some of those rates even went negative for a while. You can see right here in the late teens and early 2020s. So, and they've always been much lower than the US interest rates. Now you can see the 10-year bond is still lower than the US 10-year bond. You got 176 US 10-year bond, of course, is over 4%, and same with the US 30-year bond. But it's catching up now. You can see that we've gone from negative to 170. So you're not necessarily seeing this cheapness in the bond and borrowing at these levels. Now, granted, you can still borrow at very short-term levels as well, in Japan, much lower. But again, they're raising short-term rates as well. So that kind of incentive to borrow on yen and then go speculate all over the world is kind of ending because the rates are becoming more normalized and closer to the US rates. And also one thing that happens is usually with the Japanese yen trade or carry trade, the yen tends to go down when risk assets go up. Like you kind of saw that here. This is the late 90s, when you had that huge bull market. And again, after about 2011, 2012, you saw, you had a big bull market in stocks when they were doing a lot of quantitative easing and financial repression in terms of repressing volatility. And we saw markets rally while the yen went up. And then you see some of these spikes like here, starting, during the financial crisis, etc., when become more risk off. Why? Because people then, when it becomes risk off, they sell assets and then they go repay those Japanese loans back. And when they repay the loans back, of course, they have to convert the money back into yen, which just causes the yen to spike up in the price. And you can see the yen had this huge rally starting in the 1980s when the US dollar was devalued in the mid 1980s. And the yen went up almost 3 times in value until its peak. It wasn't the all-time peak. That happened in 2010, 2011, but this intermediate peak that lasted actually for over almost 2 decades, during that time period as well. So anyhow, so you can see that huge rally, and like there's real life consequences to this. Like one funny story I always like to tell is I was a big fan of this maybe I'm 8 years old, and I was born 1977. And I was a big fan when I was a kid of this Japanese animation cartoon called Robotech, and it was based on this. It was actually taken from a cartoon called Macross. And anyhow, what they did is they brought it out in 1985, and they just changed the name and changed the plot a bit. And then there was basically 90 episodes. It appeared over about a year or two, and then they had to make new episodes as kind of a follow up. But of course, the animation and everything, all the work was being done in Japan. But it was a company called Harmony Gold, which is a US based company that was, paying for all the work to be done. And of course, when this yen went up, all of a sudden, when the yen essentially doubled in a year or two, Harmony Gold could no longer afford the Japanese work because you were paying them in yen. And the whole cartoon got kiboshed, and the follow-up series never happened. So it just shows you can have real life effects towards us. Hey, maybe with the yen going down, they'll bring back Robotech. So there's just a little funny kind of segue there. So, but what we can see with the yen is the yen is close to breaking down, and this is not a risk on trade at this point. What's going on with the yen breaking down is they are raising interest rates because of inflation going higher and because they just have too much debt. And I think you are getting a bit of a bond vigilante factor going on in Japan as well. And you can see if you break this area of the yen here, this little pullback that happened into 1990, you're going to be at nearly a 40-year lows to the yen. And then really from a technical term, when this area, which is right about where we are now in the low 60s, breaks here, this is kind of an inverse of the yen. I think the yen is at like 150 or so. But this is like the actual yen kind of turned upside down for the sake of this chart. So we can see if he goes there, there's really no support back into that level of the 80s. So, and of course, Japan, the problem is that Japan has to import most of its natural resources for its large manufacturing, car manufacturing, electronics manufacturing sectors, steel manufacturing. And of course, those are priced in US dollars, which is going to cause more inflation and also squeeze margins because they're not going to be able to, like it's going to cost more and more and more. Now, I guess one way they'll luck out is that the wages are fixed in yen, but it's going to be a real problem. And of course, like I said, they have to import all their oil and gas, et cetera. So it is going to continue to cause more inflation, which you could say maybe causes them to have to raise interest rates even more, and they can't afford it. Another reason they can't afford it, the Japanese debt is 260% of GDP, the highest level in the world. Now, granted, the central bank owns about half that debt, but there's a two-fold factor here. As that goes up, the interest payment goes up on the part that is not owned by the central bank, and the central bank starts accumulating huge losses because, as we know, as interest rates go higher, bond prices go lower. So, and as we can see, the 10-year bond, the 30-year bond here in Japan, this is going back to 2000, is now at 25-year highs. We have never been this high. And again, in the late 2000 teens, early 2020s, we were under 1% on that. And we've spent most of the last 20 years maybe around 2%, the median around 1.5%, and we've now broken through this. And again, this isn't that much lower than the US bond market as well. So whoever owns these bonds is sitting on huge losses. And also the whole risk on trade of, I'm going to borrow a Japanese 10-year bond at 1%. And remember, this is a 30-year bond. If I borrow a 30 years, or like say you do the equivalent of a Japanese loan at, based on the 30-year bond. If I'm borrowing at 1.5%, I'll have to pay that back for 30 years. So I can go speculate for 30 years and hopefully make 10% of my money in whatever US equities, commodities, whatever risk on trade you're doing. And then, then pay off that 1%. Well, now you're borrowing at 3% and it's not as incentivized for people to do that. And then if people are sitting on losses, they're going to have to bring that money back. And then here's another issue. And this is another segue with the Japanese government. If they start having serious debt problems and economic problems because the government can't service this debt, well, guess who the highest holder of US treasuries is? You can see it right here. It is Japan. Japan owns nearly $1.2 trillion of US debt. And you can see it's continued to grind higher this year. And there are some theories out there of a great unwinding. You can see United Kingdom owns 865. China has been selling. China at one point was the largest owner. Now, some of this stuff is owned through intermediaries in the Caymans and Luxembourg and some of these tax havens. But you can see for the most part, China's kind of has slowly unwinded its U.S. debt, and Japan is continued to increase it. And if, again, they have currency problems, they have debt service problems, Japan may have to bring this money back home for the economic emergency issues. And not only that, they may be bringing back the money back home for stimulus. They may say, okay, well, we rather have $300 or $400 billion of this debt, back home to infrastructure projects, government projects, to kind of help our fledgling economy. So that's another part too. And of course, that puts pressure on U.S. treasuries, which then pushes pressure on Japanese treasuries as all yields are pressurized around the world. So again, it becomes this kind of snowball effect, and people aren't paying attention to this. People are looking at the Magnificent Seven. They're looking at the AI bubble. They're totally ignoring this right now. And so that is something that could really cause a risk-off trade or a bear market, et cetera. And at some point, with all these Western democracies having huge debts, huge welfare states. We knew something is going to happen with a debt crisis. And it makes sense that it would happen in Japan first, because they, of course, have the largest debt. And in terms of demographics, they're kind of, for whatever reason, 10 years ahead of the rest of the West. Where the US is going to have problems with Social Security and the baby boomers really retiring about 2030, Japan has been in this issue, had this issue now for the last 5, 10, 15 years. So they're kind of ahead of the West in that too, as well. So this is really a unique trade. And again, if it triggers selling financial markets, also if it just triggers, okay, Japanese rates are too high now, we can't borrow in yen anymore. That reduces risk on kind of a risk taking mentality as well. So, and the Japan can only do so much to intervene in their foreign currency. And again, how are they have to intervene? Maybe they sell treasuries and bring, the money back home. That's a way to kind of try to support the yen as well. So this is really, really important. And I do think there now is a disconnect where we're not seeing, oh, the yen selling off is risk on, right? Borrowing in Japan, selling yen, buying dollars, buying whatever, buying European stocks, whatever your risk on trade may be. I think we're seeing it as more to do with the reflection of the economy there, of the issues with debt, etc. And here's where it really affects the average person in Japan. A few people realize this, but Poland now has a higher a GDP per capita than Japan. And why? GDP per capita, again, is measured in US dollars. So since 2012, for example, the Japanese yen has fallen half against the US dollar, which means that you would have to, your per capita income in Japan would have to double in Japanese yen terms just to stay pace with the US. So, of course, your GDP per capita in US terms goes down a lot. And obviously that affects the number as well. But because of all these factors with the high debt loads, the slowing economy for decades, etc., you're seeing Japan becoming less rich on a per capita basis. And something like Poland, who has really, expanded their economy, become free market orientated after the collapse of communism, is now ahead of Japan, which is really quite remarkable when you think about where the world was in 40 years ago, and Poland was part of the Soviet bloc, and how poor Poland was. And now that on a per capita basis, they're richer than Japan. That really is quite remarkable. So one thing that has kind of happened to with all of this, and we're going to go look at the Nikkei, is the Nikkei has gone higher recently. You see, it did have a big drop the other day, over 3%, but 52,000. It finally broke out of like the highs that were set over 40 years ago, during the bubble. But again, a lot of this has to do. There's no coincidence that when I showed you that yen topping, that the Nikkei has really taken off from about 8,000 down, by the way, nearly 80% over a 20-year period, and taken off because again, even in US dollars terms, this is up, right? Like if we divide the Nikkei by the up, even though it's gone up more than that, you can see in US dollar terms, this is up. And what we can see is, because it's up sixfold in price, where the Japanese yen has fallen half. So roughly, you're still up 3x in US dollar terms in Japanese stocks. And that was partly because Japanese stocks were very cheap and depressed in price down here as well. And of course, even without some of the inflationary import pressures of raw materials, of course, now that they're getting way more dollars or euros for their products, this short term is helping Japanese companies, especially the companies that sell overseas, etc. So, but anyhow, you've seen this kind of move higher. But again, at some point, do you get a kind of reversal of this trade where it's like, okay, the yen's being devalued, it's good for some of the exporters, it's good for Japanese equities, but at some point, if these rates go high enough, does that slow the economy enough or cause an exodus from Japanese assets that you see it reverse? And obviously, that will change. When the Japanese, that could change this trade. When the Japanese Nikkei was about 14,000. I wrote an article in something called Financial Intelligence Report. It's something that Money News, which is the financial arm of Newsmax, does. I wrote that, and I said that Japanese equities looked very, very cheap to me. And of course, the Japanese stock market, you see, has gone up a great deal, even in US dollars adjusted terms. And you could always do some dollar hedging, and while you were long Japanese stocks as well. So anyway, I just wanted to show you that it's interesting because I have been worried about this for 20 plus years because of the high Japanese debt load. But one thing I failed, and I always say this, like you always make your mistakes too. realize at the time, I didn't know all these financial shenanigans were going to go on. Quantitative easing, government buying debt, negative interest rates, ZERP. I did not realize the lengths the central banks would go. I just thought the bond vigilantes were going to step in and cause this to go higher. And anyhow, you can see here, and this is interesting on the 10-year bond. So the 30-year bond is ahead of the 10-year bond, but you can see right here, 2% or so is the key level on the, and especially 2.5, which is this little spike that happened back here in 1998. And you can see here. So when that happens, when you go through 2.5%, then you're going to 30-year highs on the 10-year treasury in Japan. And of course, the nominal debt, the total debt is much higher in Japan than it was 30 years ago. 30 years ago, Japan was just starting the bust in this long-term kind of debt bubble that they've been accumulating since the bursting of their asset bubble in the late 80s. So that is kind of the key indicator. And, much more bonds are issued in the 10-year level than, say, at the 30-year level. But I think, too, again, when you're talking about bond vigilantes, or you're talking about, all the stimulus that has happened in recent years, we saw trillions spent in the United States and around the world during COVID. I think that you're seeing maybe the bond market, the vigilantes are coming back, because one reason you're seeing this spike in Japanese rates, and you'll see it more in the 1-year chart. You can see, basically at the beginning of the year, Japanese 10-year bond started at 1%, and now it's up 0.75%, it's up 75% roughly. And of course, the 30-year bond is up even more. We'll go look at the 1-year chart of the 30-year bond. You can see the 30-year bond started the year at 220, 227. It's up north of 1% on the 30-year bond, in price, in just 1 year, up over 50%. And you take a 5-year chart, you can see the 30-year bond again is up from under 1% to 330, is up nearly 5x in yield. So, so maybe now the bond markets are reacting to, hey, now you have too much debt. You can't do this anymore. So we'll see what happens, but this is something that's key to watch, because I do think if you were to get this trade really kind of getting out of control, the yen crashing to 34, 35, 40-year lows, bond yields spiking in Japan, you would see kind of the hit the fan, and you may have to see repatriation of debt from Japan, from the United States back to Japan, to kind of support their economy. So I guess I'll just leave it at that, and it will be interesting to see what happens. Oh, there's one quick remark I would like to make on foreign debt. This is the total foreign debt here. Now, you can see the total foreign debt in the U.S. has gone from about 6 trillion to just over 8 trillion, or 9.2 trillion, actually. So up 50%. But of course, debt is up much, much more than that in the United States. Of course, that's $3 trillion. Like, since the last 10 years have seen probably the U.S. debt go up 20 trillion. So only about 15% of that new debt is being taken up by foreigners. I'm using rough estimates because I don't have the number in front of me, but I know, we know that during COVID, the 4 years, basically from 2020 to 2024, well over 10 trillion was borrowed. So anyhow, we're seeing foreigners buy a lesser portion of this. Foreigners, I think, at one point owned north of 45% of U.S. debt, and you can see now at 9.2 trillion, they own about a quarter. So their percentage of the total holdings is going down. It's more because they're buying less than actual selling, and partly because the U.S. is so indebted, it's not as solid as an investment as it was seen. So, and again, you're seeing this kind of transformation. Look at this happens to economies when they borrow too much. I think you're seeing this, even though Japan in a lot of ways, technologically is still very advanced and it's still a first world country, but it's kind of like Argentina was the third richest country per capita in the world after World War II, and Argentina became a basket case. Well, if Japan doesn't sort itself out, it's going to go back from being a developed country into a developing country. And, its GDP per capita will continue to decline, and it could go into that range where it's not much richer than some of the developing countries in Asia. So this happens when countries go too far in debt, et cetera, et cetera. So that's another point to make. So I hope you enjoy this. It will be interesting to see if this Japanese trade does become unruly and trigger some kind of risk-off, major sell-off in markets. And it's something no one's talking about right now in markets. People are talking about Magnificent Seven. Maybe if you are bearish, people are talking about tech bubble, but they're not talking about a macro factor like this. So I hope everybody enjoyed this video. And I'm making this a pay video because I think this is a very important thing to discuss.